Halfway through 2017, policymakers and the business cycle continue to be our key areas of focus for our economic outlook. I'm Marija Majdoub, Vice President, Investment Strategy at MD Financial Management. There's still some room for a debate if there is an economic slowdown in the U.S. The Fed certainly believes that the first quarter, which was a bit slower than in the past, is not a reflection of the rest of the year. We closely monitor at MD indicators of economic growth and business surveys which continue to show expansion in the U.S. So going forward, we have three scenarios for 2017 in terms of economic growth, Fed actions, and equity markets. The first one is that the U.S. economy continues to grow and inflation hits its target at 2%, and the Fed raises rates and reduces its balance sheet. This is positive for equity markets. The second one is that inflation does not come near the 2% target for the Fed, and growth is reasonable. The Fed pauses and does not raise interest rates. We think this is also positive for equity markets. Our last scenario is that inflation is low, not near the target, but the Fed still chooses to raise interest rates. We think this would cause an economic slowdown in the U.S. and be very negative for equity markets, both in the U.S. and globally. With this last scenario being the least probable in our opinion, we think equities will continue to outperform bonds over the next 12 months. Canadian banks and the financial services companies have performed really well since the early 2000s and didn't get affected much by the great financial crisis. Going forward, we have some concerns around their continued profitability, given the highly priced real estate market in a rising interest rate environment, combined with the weakness in the energy sector. The Bank of Canada's recent decision to raise interest rates in Canada hasn't been received very well by the market. Our stock market is the only developed market to have delivered a negative return year to date. We do wonder if Bank of Canada may have raised interest rates too early, given that their primary mandate is to manage inflation to a target of 2%. And at a current level of 1.3, we simply don't see those inflationary pressures. We also worry about Canadian exporters being impacted by the stronger Canadian dollar as a result of increase in interest rates. We started the year cautiously optimistic with a neutral position to equities despite the strengthening economic data. We had some concerns around the political risks, particularly in Europe, and a slowdown in the business cycle. Since then, we've seen the abatement of the political risks in Europe, and we've also seen a continued improvement in earnings growth trend. And that encouraged us to increase our weight to equities to a neutral overweight. Within equities, we reduced our position in Canada, as we do have some concerns around oil prices and we see better opportunities in international equities. We also increased our position in international equities to a neutral overweight. Within fixed income, we neutralized our duration by selling long bonds, given our view that yields will continue to appreciate gradually. In terms of performance, Q2 certainly saw more volatility both in terms of stocks and bonds, as well as currencies. Tactical asset allocation was flat for the quarter, as our underweight to international stocks for the majority of the quarter offset the positive performance generated from all other positions. All our portfolios were relatively flat in terms of performance, and the ones geared more towards equity experienced better results. Our international funds and pools did quite well for the quarter, but both our Canadian equity and Canadian bond products delivered slightly negative performance in line with our benchmarks. One of the biggest contributors to our performance has been the underweight to the energy sector. With oil prices coming under pressure once again in 2017, the dividend pool has benefited from having half the allocation to the sector relative to the benchmark. Another strong contributor has been an underweight to the gold industry, which has also been under significant pressure recently. Stock selection was also a strong contributor to our performance, especially in the healthcare sector. For example, avoiding Valiant served the fund quite well. The pool continues to be positioned as it has been since it was restructured, with an underweight to energy companies due to their high level of volatility, and underweight to gold companies as this sector provides very little yield, which is a requirement for the pool. Overall, the pool has significantly less volatility than its benchmark, and we continue to expect that the pool will provide downside protection and outperform during market sell-offs, but underperform during cyclical bull markets.